Alright, let's talk about the great crypto reset, but not the kind you probably think, because so far this year, crypto has lost over $1 trillion off its market cap, and one of the reasons why we've been going down this year is because of the collapse of a little known project you might have heard of called Terra Luna, because today it's back. Originally created by Terraform Labs, let me give you a perspective of just how massive this project was, because this was a coin in the top 10. Their market cap reached over $40 billion. It was the second biggest project in the DeFi space right behind Ethereum. In fact, in 2019, in just one day, their ICO raised over $62 million. The project even had financial backing from some of the biggest names in the space, like Galaxy Digital, which raised over $25 million, another VC called Chiron Capital, which put up $50 million, but in total, the LFG, which is the Luna Foundation Guard, which is the body that governs the whole project, raised over $3 billion. These are the kind of numbers that we're talking about here. This is not a typical stablecoin. This was big. It was so big, in fact, that the lunatics, which are people that are supporters of the Luna project, took out loans and borrowed, in some cases, hundreds of thousands of dollars to invest in this project, and some of them ended up losing their life savings. Now, if you're a normal person who's maybe not into crypto as much, you might be thinking the obvious, why would anyone stake all of their life savings into something as risky as crypto can sometimes be? And this is where it gets crazy, because there was something called the Anchor Protocol on Terra Luna, which promised that if you deposit or stake your coins in there, they would give you a 20% return per year. 20%. This is insane. For perspective, the stock market in a good year gives you something like 7% factoring inflation. That's almost 3 times less. Dividend investors, which I love dividend investing, promises to give you something like 4%, and that's also not guaranteed, so 4% is somewhere in the safe ballpark, but still that is 5 times less than that 20% mark. So imagine the allure of borrowing as much money as possible, because as long as your loan interest rate was lower than 20%, which isn't that hard to do, then you basically have a license to print free money. It's like an infinite money glitch. And since stablecoins are meant to hold their value and be stable, it seemed like a guarantee. But that's not what ended up happening. The project collapsed and people lost 99.9% of their money. Today, Terra Luna had a reset, and now it's back in the form of Terra Luna 2.0. So in today's video, I want to talk about what's going on and how to protect yourself. So let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the crypto. It's been a while since I made a crypto dedicated video. See, I'm not a crypto channel after all. I knew it. So first, I'll help explain exactly how this works, what led to the collapse. We'll talk about Terra Luna 2.0, and then I'll tell you how this will affect all of us, and then I'll give you my thoughts at the end. But first, a full disclosure. I do not own Terra Luna, I never invested in it, but I considered doing something close to that with a different stablecoin. This is a true story, and here's why you should not do this. Earlier last year, I bought and fully paid off my first house, and then I looked at it and I thought, well, this house is not making me money, so I locked up all of this cash, which is not being productive, so how do I put it to work? And then I thought, I could take out equity out of the house, put it into a stablecoin like USDC, for example, because crypto brokerages love stablecoins. They love to lend them out to their clients and institutions, and in return, they pay us a really high interest rate of 8 to 10%. So I thought, I should take out 80% of the equity out of my house, not the full 100, right? Because I don't want to pay the PMI. And then I could park it into a stablecoin and earn a really high interest rate that is way higher than the interest rate of my new loan. So not only would I be able to pay off the loan, but I would also make some extra cash on top of that. Then I thought, Andre, don't do anything reckless, just leave the house alone, leave it paid off, and luckily I did. But some people didn't, and they trusted their entire life savings into Terra Luna and they lost it all. And some people even went a step farther. Like this guy, Mike Novogratz, who's a billionaire who got the Terra Luna project tattooed on his shoulder. It's pretty crazy. It's like getting a tattoo of someone who's about to break up with you. So I hope he can cover it up and maybe put Bitcoin on there, but these are the things that keep me up at night. So now let's talk about how Terra Luna worked and what led to its collapse and the creation of the new Terra Luna 2.0. So Terra relied on another crypto called Luna, and the easiest way to understand this system is by showing you an analogy. So full credit to this gentleman right here who came up with the analogy, but picture this power brick brick right here is Terra, and what powers it is the cord itself, which is Luna. Crypto backed by crypto. Not my joke, but I thought it was great. So once again, full credit to On-Chain Wizard for his amazing analysis. Let me show you how this system works and what led to its collapse, and I promise this will be super helpful in protecting yourself in the DeFi space in the future. So in crypto, there are 4 different types of stablecoins. There's fiat-backed ones with something like the dollar 1-for-1. There's crypto-backed ones, which are ones that are backed by a stronger crypto like Bitcoin. There are commodity-backed stablecoins, which are backed by something like gold. And then there's algorithmic stablecoins, which are backed by a series of very complicated algorithms. Now, Terra Luna was a hybrid, but it was mostly an algorithmic stablecoin. And the way that it held its dollar value was by relying on another crypto called Luna. So the promise was that you would always be able to exchange 1 Terra for $1 worth of Luna. So the two acted as sort of a volatility price shock absorber to keep the price stable. So along comes the Anchor protocol, which promises to pay people 20% yield on their money. And that got people so excited that the total value locked in the system went from $1.1 billion in May of 2021 to $17 billion by May of 2022. Now, if you've been keeping track so far, $17 billion staked at a 20% interest rate means that someone has to be paying out $3.4 billion per year to keep their users on the platform. The only other way is to drop the interest rate, which they didn't want to do because they didn't want people to leave. Now, you might be asking, who's paying all this money? Where's the $3.4 billion coming from? And this set the stage for one of the biggest collapses that we've ever seen in all of crypto, because there was one major flaw in the system, which was liquidity. And here's how it all happened. This is insane. Remember that at this point in May of 2022, the Anchor protocol had roughly $17 billion locked up, but the trading volume, or liquidity, was only $600 to $700 million per day across all platforms. This means that the exit door was very narrow. Now, if you're confused by what that means, imagine going to a concert with 10,000 other people there, but there's only one exit door, and it could only support maybe 2 to 3 people at a time. And imagine then that something scares the people at the concert and they all run for the exit. 10,000 people all at once. It would be chaos and it would cause a ton of damage. And that's exactly what ended up happening. Now, the thing that caused people to become scared in the first place is an attack. The attacker noticed that Terra Luna was running low on funds to pay for interest. They also noticed they were spending money to buy Bitcoin, which meant they had even less money to protect themselves against an attack. And they also noticed that the liquidity was running low. In other words, the door was shrinking. So the attacker spent $350 million worth of UST to drain the liquidity. In other words, shrink the door even more. And that's when brokerages started to notice that something was off. And so they froze trades. And that's when people started to panic. They wanted out. And that's when the attacker spent another $650 million to sell UST on Binance, which depegged the value from the dollar all the way to fractions of a penny. In other words, people ran for the exit even through that narrow door because they didn't care how hurt they got as long as they got out. So they sold at a loss even if it meant selling below that dollar. Now, the attacker is estimated to have made at least $800 million from this attack. So to summarize it, the project collapsed under the weight of its own success. It got too big for its own shoes and they couldn't afford to pay the interest. So the attacker noticed this vulnerability, it scared people, everyone ran through the exit of a really narrow door and got hurt. That's the easiest way to explain exactly what happened. Now, the most important thing that I personally learned from this entire collapse is this. Number one, stablecoins are not always stable. They are just experiments that can fail for a virtually unlimited amount of reasons. There are no guarantees in crypto, even with stablecoins. Number two, always understand where your interest rate is coming from. In other words, if a stablecoin promises to pay you an interest rate, no matter how big, no matter how small it is, you have to understand how it's generated. If that interest is generated by lending assets to others, that's a different story than if the interest rate is paid by the organization, because funds eventually run out. And number three, always pay attention to the liquidity. So I can't overestimate or overstate just how important those lessons are. Now let's talk about how this project is coming back in the form of Terra Luna 2.0. The way this project was revived today is through Proposal 1623, which was voted by the community with an overwhelming consensus of 65%. So this will be its own separate project with its own Genesis block. In other words, it is not a hard fork of the previous chain. It's its own separate thing. So the old chain will be renamed to Terra Classic with a ticker symbol LUNC, and the new one will inherit the old name of Terra Luna with the ticker symbol Luna. People will also receive some equivalent amount of Luna as they had before the attack took place, except the difference is there will be no more algorithmic stablecoin. In other words, no more UST. They're also getting rid of the reserve wallet, which remember had all the money to pay for all that interest. Now, there's a lot more details that goes into this, so if you're someone who was affected by this, I'm gonna leave a link in the description below the video where you can learn more, but the real truth behind the damage that Terra Luna caused goes way beyond people losing money. Here are my personal thoughts. Now, I can't tell you whether you should invest in this new project or not. You'll have to make up your mind for yourself, but ultimately, as much as I sympathize with the people that lost their money, the real damage will come from regulating the entire crypto space, because there is one thing I didn't talk about in this video, which is the Mirror protocol, which was also created by Terraform Labs, which is a platform where people can trade synthetic shares. These are stocks that represent real companies like Tesla, which are traded on the blockchain 24/7. And this is a really cool idea, and maybe 5 to 10 years from now, we'll be using that idea without even knowing about it. But for now, the SEC does not like it, and they made sure Terraform Labs knew about it. So ultimately, the collapse of Terra Luna means the SEC is going to want to regulate the stablecoin space even more, which increases our risk because remember, many of these stablecoins are the reason why crypto skyrocketed in price. So if there's one thing I can tell you personally, it's to please be careful. Don't let yourself get carried away and get greedy by borrowing and leveraging money to buy these stable coins to earn some interest. Even high interest rates are not worth anything if the thing you're buying ends up going to zero. That's why I never leveraged my house to do exactly that, because it's risky. There's no guarantees and there are no promises in crypto. So please, please, please stay safe and be careful. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin with this link right here. Grab your free stonks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Go check out On-Chain Wizards analysis. It is behind a paywall, but it's worth it because you will learn a lot. So I will see you back here on Monday and Friday. Love you. Thank you so much for watching. I'll see you soon. Bye-bye.